Welcome to the Trade Trends channel. In this video we're going to talk about moving average and exponential moving average. Why we use them, their formula, examples and best periods for day trading them. In statistics, a moving average generates a series of subgroup averages to investigate data points. Moving average is a technical analysis stock indicator. Moving averages help smooth out price data by giving an updated average price. By calculating the moving average, unpredictable, short-term price fluctuations are eliminated. Moving averages are used to determine a stock's trend and support and resistance levels. Since it depends on historical prices, it's a trailing or trend-following indicator. Moving averages are flexible, so investors may pick any time frame when calculating an average. Moving averages employ 15, 20, 30, 50, 100, and 200-day increments. Shorter time periods make the average more subject to price swings. More time, less sensitive average. Traders may use different time periods to calculate moving averages based on their trading aims. Traders use MACD to compare two moving averages. It's calculated by subtracting the 26-day and 12-day exponential moving averages. Positive MACD puts short-term average above long-term. Short-term averages below long-term averages suggest negative momentum. Traders also watch for a move above or below zero. Above zero is a buy signal, while below zero is a sell. SMA versus EMA calculate moving averages differently. The following securities have 15-day closing prices: 20, 22, 24, 25, 23 first week, 26, 28, 26, 29, 27 second week, 28, 30, 27, 29, 28 third week. A 10-day moving average starts with the first 10 days, closing prices. Moving average shows average data set change over time. Technical analysts track stock prices using moving averages. A rising moving average trend may suggest an asset's growing price or momentum, whereas a falling trend indicates a drop. Moving averages range from simple data to complex formulas that need a computer program to calculate. Most traders utilize moving averages. Most traders make fatal mistakes while trading with moving averages. In this video, I'll show you how to determine the kind and length of the optimal moving average in 3 ways to use them while trading. Every trader first wonders whether to utilize the EMA or the SMA. The moving average you pick may affect your trade, despite their slight differences. EMA and SMA vary mostly in speed. EMA travels and changes direction faster than SMA. The EMA gives more weight to recent market action, thus it recognizes price movements sooner than the SMA. After choosing a moving average type, traders must pick a period setting. Determine if you're a swing or day trader. Second, know why you are using moving averages. If you're a day trader, you need a fast-responding moving average. Day traders should use EMAs. Moving averages are used to measure time and length. Period 9 or 10, it's incredibly popular and moves quickly. 21 period moving average is the most accurate. 50 period moving average for long-term patterns. Swing traders trade on larger time frames and hold trades longer. Swing traders should initially use a SMA to decrease noise and early indications. Here are a few moving averages that swing traders should know. 1. Most swing traders prefer 21 moving average. Price watches trends and announces changes. Second, 50 period moving average is most popular in swing trading. Most traders use it to ride trends since it's the right length. Third, 100 moving average is round, which is attractive. It's great for daily and weekly support and resistance. Fourth, 200 and 250 moving averages have the same time frame. On the daily chart, the 250 period moving average reflects 1 year of price action. 1 year comprises 250 trading days. Bollinger Bands evaluate price volatility around the 20 period moving average. Price fluctuates around the moving average, but outer bands are key. Price reaching the outer bands during a range often signifies a reversal, particularly if it's followed by a rejection. Bollinger Bands are effective for assessing price even when moving averages lose their validity. Bollinger Bands help you stay in trends. When the outer band is breached during a trend, it implies a pullback, but not a reversal until the moving average is broken. Moving averages are a multifaceted tool that may be utilized in a number of ways, as you can see. Moving averages become a significant tool in a trader's toolkit after they grasp the ramifications of EMA versus SMA, the relevance of the self-fulfilling prophecy, and how to choose the proper period setting. An exponential moving average emphasizes recent data items. It's also called the exponentially weighted moving average. Exponentially weighted moving averages respond more to recent price movements than SMAs, which weight all data equally. EMA needs an extra observation than SMA. Assume you want 20 days of EMA observations. The SMA isn't available until the 20th day. On day 21, utilize the previous day's SMA as yesterday's first EMA. Simple SMA calculation. It's the total of stock closing prices over a period divided by number of observations. This 20-day SMA is the sum of the last 20 closing prices divided by 20. The EMA places more importance on the present price than the SMA, which places less importance on the past. Shorter-term EMAs give greater weight to its current price than longer-term EMAs do. A very recent price information is multiplied by 18.18% when using an EMA with a 10 period, while using an EMA with a 20 period, results in a factor of 9.52%. When computing the EMA, one may conceivably arrive at a substantially different answer if rather from using the closing price, they use the opening, high or low price, or the median price instead. Alternatively, they could have used the median price. The 12-day and 26-day exponential moving averages are the short-term averages that are most often discussed and analyzed. Indicators such as MACD and PPO are constructed using the 12-day and the 26-day moving averages. 50 and 200-day EMAs are long-term trend indicators. Crossing the 200-day moving average implies a reversal. Moving averages are beneficial and enlightening for traders using technical analysis. These signals may cause disaster when utilized poorly or misread. Technical analysis moving averages all lag. Consequently, a market chart's moving average should corroborate or signal the strength of a given market move. Moving averages typically miss the optimum timing to join the market. An EMA reduces the effect of delays. Because the EMA gives current data more weight, it hugs price action and reacts more quickly. When a trade entry signal is derived from an EMA, this is a desired outcome. Like other moving averages, EMAs favor trending markets. A strong and persistent uptrend in the market will also be shown by the indicator's EMA line, and vice versa for a downturn. Vigilant traders pay attention to the EMA line's direction as well as the pace of change between bars. Suppose an upswing flattens and reverses. Opportunity cost suggests switching to a bullish investment. EMAs are used to validate market fluctuations and measure their validity. It is easier to use the EMA when trading intraday in markets that move quickly. EMAs are often used by traders to establish a trading bias. If an exponential moving average, EMA, on a daily chart reveals a robust rising trend. An intraday trader's approach may be to focus only on the long side of the market. EMA and SMA vary in how sensitive they are to changes in their data. The EMA provides more weight to recent prices than the SMA does. Both averages are employed by technical traders to balance out price volatility and are perceived similarly. EMAs are more sensitive to price movements than SMAs since they weight current data more. Traders like EMAs because their returns are more timely. It's uncertain if recent days should be prioritized. New data, say traders, better depicts the security's trajectory. Others believe that emphasizing current dates leads to more false alarms. The EMA only uses historical data. Many economists think markets are efficient, meaning current prices represent all available information. If markets are efficient, previous data shouldn't predict future asset values. Long-term investors employ 50 and 200-day EMAs, while short-term investors use 8 and 20-day EMAs. When a moving average, EMA, rises, it is seen as a sign of support for the market, and when it falls, it is seen as resistance. It is a common belief among investors that they should purchase when prices are near the rising or falling EMAs. If you've got something to say about moving averages, or something you want me to cover next time, please drop us a comment. And if you like this video, I implore you to please make sure you smash that like button, subscribe and hit the bell icon. Thank you very much for watching and happy trading.